Welcome to Finmonk. Have you ever thought about what if there is an easy way to build wealth in the stock market? What if I tell you there is an investing strategy that will allow you to make money even while you sleep? What if I also tell you this strategy is so powerful that it can beat the stock market consistently? Sounds too good to be true, right? Well, it's not. In fact, this strategy has been around for decades and it's called coffee can investing. In this video, I'm going to explain what this strategy is, why it works, and how you can use it to build your own fortune. But before we get started, please hit the like button and subscribe to our channel. We publish a lot more content on investing and personal finance. So what is coffee can investing? This investment strategy was popularized by an investment manager named Robert G. Kirby in 1984. The idea is simple. Just imagine you have some of the best performing stocks in your portfolio, and you keep adding them to a coffee can. Then you forget about it for 10 years and just leave it alone. That's it. No selling, no panic, no reaction to market noise. Just letting your investments grow and compound over time. But why should you care about this strategy? Well, here's why. When Kirby first introduced this strategy, he had a client who had followed this approach unknowingly for years. She never touched her portfolio, and it turned out that her portfolio had outperformed the one that he had been managing for her. See, when she passed away, he discovered that her portfolio was filled with her late husband's best stock picks, and she had never sold them. Even after his death, he noticed that these stocks had grown substantially in value and had outperformed the S&P 500 by a wide margin. This is because she didn't panic sell during market crashes and she didn't buy into market hype. She just held on to her investments and let them grow. And that's the beauty of this strategy. You don't have to be a genius investor. You don't have to spend hours researching stocks. You just have to pick wisely once, and then you can forget about it. But how do you pick wisely? Well, here's how. Step 1. Choose quality stocks. Look for companies with strong management, a competitive moat, consistent earnings, low debt, and a high return on equity. These are the key characteristics of a great business, and if you find a company with all of these qualities, it's likely to be a winner in the long run. Now remember, you don't need hundreds of stocks to build a great portfolio. 10 great companies are enough. So take your time and choose wisely. Now step 2, lock it and leave it. This is the most important part of the strategy. Don't touch your portfolio for at least 10 years. Yes, I know it's hard to resist the urge to buy and sell stocks, but trust me, it's worth it. If you stick with this strategy, you'll be able to avoid the pitfalls of trading and focus on the long term. During this time, reinvest any dividends you receive back into the stock. This will help you buy more shares and increase your ownership in the company. And if you can do this consistently, you'll be able to reap the benefits of compounding. Compounding is a powerful force, and it can make you a lot of money over time. Albert Einstein even called compounding the 8th wonder of the world. So don't give up on it. Finally, avoid the temptation to fix or trade your portfolio. It's easy to get caught up in the excitement of trading and trying to time the market. But that's not the point of the strategy. The whole idea of a coffee can portfolio is to set it and forget it. So try to resist the urge to trade your stocks. Instead, focus on picking the right stocks in the first place and then holding them for the long term. If you want to take your investing one step further, you may want to look into the practice of buy and hold investing. It's a very similar concept that can help you grow your wealth even faster. Now let's take a look at some real-life examples of coffee can investing. One of the most famous cases is Warren Buffett's investment in Coca-Cola. He bought the stock in the 1980s and it's been a massive success. Since then, Coca-Cola has paid him billions of dollars in dividends and his stake in the company has grown exponentially. Another example is the Indian company Marcellus Investment Managers. They popularized the coffee can investing strategy in India and their long-term performance has been stellar. They've delivered returns of over 18% per year for more than 2 decades. And the secret to their success is simple. They pick high-quality stocks and then hold on to them for the long term. But what if I told you there's a way to make investing even easier? It's actually quite simple. All you have to do is follow these 3 steps. First, choose quality stocks. Look for companies with strong financials, a competitive advantage, and a history of innovation. Then diversify your portfolio across different sectors and industries. This will reduce your risk and increase your chances of success. Finally, invest regularly and consistently. Don't try to time the market or panic sell when things get tough. Just keep buying and holding great companies and you'll be able to build wealth over time. And here's the best part. You can do all of this through a single platform. But let us talk about some of the common mistakes to avoid when using the coffee can investing strategy. Mistake number 1. Don't pick speculative stocks. Only invest in companies that have a proven track record of success. This means avoiding companies that are too new or too risky. Otherwise, you could end up losing a lot of money. Mistake no. 2. Don't check your stocks every day. If you're constantly monitoring your portfolio and reacting to market fluctuations, you're not practicing the coffee can investing strategy. In fact, you're just day trading. And as I said earlier, day trading is not the way to go if you want to build long-term wealth. Trust me, it's better to just check your portfolio once a month or once a quarter. That way you won't be tempted to trade your stocks and you'll be able to stay focused on the long term. Mistake no. 3. Don't over-diversify. It's not the number of stocks you own that matters, it's the quality of those stocks. So don't spread yourself too thin trying to invest in too many companies. Instead, focus on picking the best stocks you can find and holding them for the long term. And finally, mistake no. 4. Don't be impatient. Compounding takes time, and if you want to see results, you have to be patient. Don't expect to get rich quick. Just stay focused on your long-term goals and keep investing in great companies. I hope you enjoyed this video and learned something new. If you did, please give us a like and subscribe to our channel. We publish videos on investing and personal finance that can help you grow your wealth. Thanks for watching, and I'll see you in the next video. Bye-bye.